Hi everyone. We are going to now take a look at a few of the problems in Chapter 7 to help you understand this whole foreign currency translation and the different scenarios they are introducing here. There's a lot of stuff in this chapter. So we're first going to take a look at number 28 on page 377. On April 1st, 2017, Mendoza Company borrowed 500,000 euros for 1 year at an interest rate of 5% per year. Mendoza must make its first interest payment on the loan on October 1st, 2017, the second one on March 31st, 2018, and that is when the loan is repaid. Mendoza must do their financial statements in US dollars. Now remember, they're borrowing euros, but they must prepare their financial statements related to this borrowing in terms of US dollars. And they have a year end of December 31st. So this is one of the first areas that's introduced in the chapter. What happens when a company borrows a foreign currency and they have to convert it to United States? Well, the first thing we need to worry about is one, the first journal entry, and that's recording the United States value, the dollar value of those euros. So in terms of United States or the dollar, cash would be debited for 550,000 because 500,000 euros would be converted. 1 euro is converted at $1.10. That's what you would receive for 1 euro. So 500,000 euros would be times 1.10 for the $1.10 or 550,000. Debit cash, credit notes payable. Now remember, we're doing this because our financial statements are created in terms of US dollars. Now nothing else is really happening until October 1st. The year doesn't end. But on October 1st, the company must pay interest at the conversion rate on October 1st. So they'll be paying euros, okay, 500,000 times 5% times 6 of 12 months, okay? So that is 500,000 times 0.05, 12,500 euros. But 1 euro is $1.20 now. So how much are they paying in terms of dollars? $15,000. So debit interest expense, credit cash for how much in terms of United States or dollars they're paying on October 1st. Now on December 31st, remember, we must accrue interest. That's the first thing. Interest related to this loan from October 1st through December 31st. That's just a normal accrual accounting. You did that back in Accounting 101 and in your intermediate accounting classes. But you never did it for euros, right? Well, we're still not, because we're going to convert the euro, how many euros we're paying, to dollars. So 500,000 is the original number of euros times 5% interest rate times 3 over 12 for 3 months. So that would be a payment of 6,250 euros. But the conversion rate, you would have to pay $1.24 on December 31st for 1 euro, is really $7,750. Now, they're not paying anything on December 31st, but because of normal accrual accounting, we must accrue that interest expense, debiting interest expense and crediting interest payable for the dollar value of those euros, $77.50. Also, any kind of gain or loss on this loan due to foreign currency difference must be recorded on December 31st. So what does this mean? Well, when we borrowed the money back on April 1st, the conversion rate was $1.10. So for 1 euro, you either paid or received $1.10. As of December 31st, though, it's $1.24. So if we had to pay back this loan, okay, on December 31st, we only received $1.10 for €1, but we would have had to pay $1.24, or a difference of 14 cents per euro. Multiply that 14-cent difference by 500,000. So we would actually end up with a foreign exchange loss because we would have paid back more than 70,000 more than we actually received in terms of US dollars. Not in terms of euros, but US dollars. So we're going to debit a foreign exchange loss account, which goes on our income statement, and credit our notes payable because we would be paying $70,000 more. Now that's as of December 31st. It doesn't mean that's what's actually happening. We won't know until March 31st, the day we pay back the loan. Now, yes, March 31st. Sorry, I was looking at the wrong problem. On March 31st, the conversion ratio is €1, $1.28. So it's even a little more money that you have to pay for €1 than it was back on December 31st. But the first thing we want to do is calculate the interest expense from January 1st to the date the loan we have to repay. So we base it on our euros, 500,000 euros times 5% times 3/12 again. I think that was 12,500. Whoops, nope, I'm wrong. 500 times 5%, 25,000 times 5 gives us 6,250 euros. But for €1, you got to pay $1.28. So multiply that 6,250 euro by $1.28. The actual US dollars is 8,000. Now, we will be paying that. We will also be paying what we accrued back on December 31st for those 3 months from the last interest payment. But in addition, remember, when we accrued interest expense on December 31st, we used the conversion rate on December 31st, which was $1.24. Nope, not anymore. It went up to $1.28. So we still need to add the additional 4 cents, because we're going to be paying 4 cents more per euro in our interest payment than we accrued for on December 31st. So take the 6,250 times 0.04. That is recorded as a foreign exchange loss, not as interest. But it's just because the euro changed value from the day that we recorded that interest expense to the date we actually paid it. So that difference, due to that time lag, is a foreign exchange loss. Credit cash for the full 16,000 that must be paid for that 6-month period. And if you're like, what? How do you get that? Check it out. 500,000 euros times 5% for 6 months. So in terms of euros, you're paying 12,500, but €1 is $1.28 in US dollars. So multiply it by $1.28. The cash is 16,000. Also on March 31st, you're paying back the loan. Now, we're going to debit notes payable, not for 550,000. Remember, we increased it because of the foreign exchange difference and recorded any loss from that foreign exchange difference from the date of the loan to December 31st in the year it occurs. And in the book, they tell you that. Any gains or losses associated because foreign currency changes should be recorded in the year of the change, even if you're not paying it back that year. Now on March 31st, we will debit notes payable for the 620,000 that is in notes payable as of December 31st. But how much are we paying back? Well, 500,000 euros we have to pay back. But on March 31st, we have to convert them at $1.28 per euro. So the cash we're actually paying back on this loan, 640,000. So we just took another hit of $20,000. A $20,000 US dollar loss because the euro is costing more to exchange in US dollars than it was from the end of last year. Okay, so that really sets, it's a great starter problem for this whole idea of foreign currency translation. So this is just one example when a company borrows a foreign currency and the resulting journal entries that occur. The next problem we're going to look at kicks it up a notch. You know, of course it does. And this is, I'm going to go up, number 33. Here it comes. Give it a second. These problems are long, aren't they? Now, in this problem, June 1st, Alexander Corporation sold goods to a foreign customer. So we are the seller. We're going to sell to this customer on account. So that means we're going to have an asset that could be at risk of not being fully collected due to foreign currency change. We sold the goods for 1,000,000 pesos. We did not receive the pesos on the day of the sale. We won't receive the payment from the customer until September 1st, 3 months later. On June 1st, Alexander decided to acquire an option to sell 1,000,000 pesos in 3 months at a price of 0.062, which is the spot rate today. So what this is saying is, remember what an option is. It's an option. You purchase this, so you have to buy it, and it's your option. If you want to convert the amount that's on the option, 0.062, and you'll do that if the conversion rate is lower than 0.062. But if it's higher, you don't have to adhere to the option. You can convert at the higher rate. Remember, a forward contract, you must convert at what the amount is you signed on a contract. But when you buy an option, you have a choice. So that's number one. They give us the relevant exchange rates there for June 1st. So the spot rate on June 1st is 0.062 per peso. June 30th, it was 0.066 per peso. September 1st, 0.061 per peso. If you purchase the put option on June 1st to lock in at September 1st for a 0.062 price, you would have paid 0.0025 per peso. On June 30th, you would have paid 0.0018 to lock in at that strike price. And at September 1st, you wouldn't pay anything because you wouldn't buy anything. You're at the date. So that's what those items mean there. Alexander must close its books and prepare its second quarter financial statements on June 30th. So that's key because any kind of gains or losses associated with differences in foreign currency translations must be recorded in the year they occur, whether you're borrowing the foreign currency, waiting for the currency to be paid back to you. Assume Alexander designates the foreign currency option as a cash flow hedge of a foreign currency receivable. Well, we know this is a receivable because the company is selling to a foreign customer and waiting for 1,000,000 pesos to be paid to them. Now, since the company prepares its financial statements in terms of US dollars and instead of pesos, they must convert those pesos to the US dollar when they're completing their journal entries. So when it comes to hedging, you can hedge using an option or a foreign currency contract, a forward contract, I mean. You can hedge for cash flow or for fair value. And depending on how you hedge, will depend on how your journal entries result. So let's see what we end up with here. When you are using the foreign currency option as a cash flow hedge, the first thing you'll do is debit accounts receivables in terms of US dollars. So 1 million pesos on June 1st when the sale occurs will convert to 62,000 US dollars. So 0.062 cents per peso. Credit sales for the same amount. On that day, when they purchase the put option, they must pay 0.0025 per peso. So 2,500 will be debited to the foreign currency option, credit cash. Okay, so a foreign option, an option that we buy must be recorded. Remember, a forward contract, we don't record on the day that we sign it, only when it starts gaining value. June 30th, that's the next significant date. We sold on June 1st, we're not getting payment to September 1st, but if that year ends in between the day we sell and the day we receive the cash, we must account for any gain or loss and any change to our foreign option value by the end of the year, because we got to get it recorded in the year the gain or loss occurs. So on June 30th, the spot rate has increased to 0.066. So the value of our accounts receivable on June 30th is 4 cents higher, or 4 cents times 1 million pesos higher. So we debit accounts receivable and credit foreign exchange gain. Foreign exchange gain. What else we have to do is record any kind of gain or loss in our option value. Here's how you look at this. On June 1st, we bought the option at 0.0025. If we had waited till June 30th, it would have only cost us 0.0018 per peso, or 0.0007 per peso less. So this is a loss, and it decreases our foreign option, our foreign currency option account by the $700. The loss is recorded in accumulated other comprehensive income under a cash flow hedge. That's where GAAP wants us to put that amount. Also, they want us to eliminate any gain or loss from foreign exchange under the cash flow hedge. How do we do that? Well, we look and we say, how much was our foreign exchange gain? How much did accounts receivable basically increase here? We're going to record the same amount as loss on foreign currency option. So you take the same amount and you record it as a loss, but we call it loss on foreign currency option. And you credit the accumulated other comprehensive income account. The final thing we do, so that's just automatic. Whatever you did to get your accounts receivable in line with the spot rate as of the end of the year, you do the opposite in that third journal entry. So if there was a loss on that foreign exchange, there would be a gain on our foreign currency option. And that goes on our income statement as well as the gain. So what's the effect on the income statement? It's washed. That $700 we recorded because our foreign currency option went down, that affects the accumulated other comprehensive income. It has nothing to do with the income statement. The final thing we do is record any change in time value as an option expense. So the value of the option was 2,500. it goes down to $1,800. That's how much we would have paid for it. So it's a $700 decrease. That's an expense that will affect the income statement. Debit option expense, credit the accumulated other comprehensive income account. So we use that AOCI account to help us gather up these differences due to foreign currency translation. Let's go to 9.1, when we actually collect the pesos. On the day that the pesos are collected, the first thing we want to do is determine if we had paid or if we were receiving the actual spot rate, what is the change from either the day of the sale or the day we revalued our accounts receivable because of the end of the year. And the second case is here. So it went from 0.066 to 0.061. So we would be receiving 0.005 less per peso than we would have at the beginning or at the end of the year, June 30th. So this is a loss, a $5,000 loss. So we want to credit accounts receivable, debit our foreign exchange loss. That's what we would have been receiving. We are not locked in. We can take that if we want. That's why we use the actual spot rate to do this valuation when you have an options contract. The next thing we do is determine how did our option value change? Well, its intrinsic value is 1,000 on 9/1. How do we get that? The difference between the spot rate on June 1st and September 1st, 0.0001 times 1 million pesos. That's its intrinsic value. The time change value has decreased from 1,800 down to 0. So how do we record? Let's go here. Your option expense then is debited for that time value change. AOCI, accumulated other comprehensive income, is credited. Remember what I said, whatever happens to accounts receivable, in this case, there was a foreign exchange loss of 5,000. You credit a gain on foreign currency option for 5,000 and debit AOCI. The difference between the fair value of the option on June 30th and September 1st, the actual date they're receiving the payment, the 800, debit AOCI, credit the foreign currency option because the value went down. It went from 800 down to 1,000. Okay, so if you actually took and made a T account for your foreign currency option, you would have a debit of 2,500, a credit of 700, and then a credit of 1,800. Oops, where is it? Or a credit of 800, sorry. So 2,500 debit, a credit of 700, okay, a credit of 800. So it would have a balance of 1,000, its fair value. Now, where does that come into play? Well, keep going. On September 1st, we transfer our accounts receivable to a foreign currency account. So we credit accounts receivable at its current value of 61,000, the current spot rate on the day we received the cash or the pesos, and we debit foreign currency. We have that value in pesos. We then go and convert the pesos using our option, because our option price is 0.062, where everybody else is only getting 0.061. Remember, when we bought the option, we had the ability to lock in. And it's a good thing we did. So we debit cash for the actual amount of US dollars we'll get for those 1 million in pesos, 0.062, what we locked in at with the option, times 1 million pesos. Credit that new account we just debited, foreign currency, and then credit the difference to the foreign currency option. Now your foreign currency option account is gone. Your foreign currency account is gone. Accounts receivables is 0. The only thing that will have a balance in this will be from your option expense. Let's take a look at the effect on the AOCI account. So if you made a T account for AOCI, you have a debit of $700 on June 30th. You have a credit of $4,000 and a credit of $700. Coming down, on 9/1, you have a debit of $800, a debit of $5,000, and a credit of $1,800. See what that balance comes to. 0. So that AOCI account is just used to gather the offsets to increasing or decreasing our option account, washing out any gain or loss due to actual differences in foreign currency exchange, and getting the option expense for that time period recorded on the income statement. Now, what's the impact on the financial statements on the net income over those two periods? Well, remember, we originally recorded sales up here at $62,000. We then recorded a $4,000 foreign exchange gain, then debited a loss on foreign currency option for $4,000. That washes. And then the option expense would be debited for $800 during last year. What happens this year? There's your loss on foreign currency, but then you have a gain. So they wash. Your option expense is $1,800 to the $700 from last year. And that's it, $2,500. So when you're using your option as a cash flow hedge, the effect on net income is very minimal. Really, it will only be any expense associated with the option due to the change in value. And having to use it, because what's that $2,500? It's how much you paid for the option. And instead of expensing it right up front, you expensed it over the 2-year time period based on the value of the option from the time that you bought it to the end of the year, and from the beginning of the new year to the day you cashed it in and used it. So that's when you use your option as a cash flow hedge. Journal entries are a little different when you use it as a fair value hedge. Along the same lines, but let's take a look at where the differences occur. First, when you have your sale, you debit accounts receivable for the US dollar amount of the pesos, and the sales is credited, so $62,000 again. You record your purchase price of your option, debit a foreign currency option, credit cash. On June 30th, you record the gain related to the increase in value on those pesos. So if you collected those pesos on June 30th, you would have collected $4,000 more in cash than you would have if you just sold them outright for cash on June 1st. So debit accounts receivable, credit the foreign exchange gain. Notice we don't eliminate that effect of the gain on net income when we use a fair value hedge. We ignore it. We don't do any journal entries. We let it increase net income. Any increase in value, or in this case, decrease in value, change in the time value from 2,500 to 1,800 on our option is recorded as, sorry, I'm flying all over the place here, but loss on foreign currency option, credit the foreign currency option, so its value goes from 2,500 down to 1,800. September 1st, we still have to record if there's any loss from the end of the year through September 1st. So there was 0.005 loss per peso. You're receiving even less cash as of September 1st if you convert at the spot rate on September 1st. So 5,000 loss, credit accounts receivable. Also, any loss, decrease in value, time value on your foreign currency option will be recorded, as you see there. Then notice we didn't do any journal entry to wash out the loss. We don't do that when we're using it as a fair value hedge. That's only for a cash flow hedge. We will still debit the foreign currency and credit accounts receivable to transfer the value of those pesos on September 1st into a foreign currency account. So now the pesos are sitting there waiting to be converted to cash. Because at this point, we've received the pesos. We just didn't convert them to cash yet. When we do convert them to cash, we'll use our option price of 0.062, debit cash 62,000, credit our foreign currency, where we transferred our accounts receivable to 61,000, and then credit our foreign currency option account to remove that account. We're now exercising it, $1,000. So what is the effect on income? Well, when you use your option as a fair value hedge, it's really going to affect net income. Okay, when you use it as a cash flow hedge, it shouldn't have a huge impact on cash flow, or on net income. Sales are 62,000. Here's your first foreign exchange gain of 4,000. Foreign exchange loss of 5,000. And then the loss on the foreign currency option would be the 800 from last year, or the 700 from last year, right above here, and the 800 from this year. So depending on how you want to use the hedge, and that's up to you. Do I want to use it as a cash flow hedge or a fair value hedge? The company decides. You don't buy an option that way. The way you do your journal entries will impact how you report net income. And that's why you would choose either of the two methods. Okay, the final problem we're going to look at is number 36. It's on page 379. Eximco Corporation, based in Illinois, has a number of transactions with companies in the country of Managua, where the currency is the Hmong. November 30th, 2017, Eximco sold equipment at a price of 500,000 Hmongs to a Mangaguian customer that will make payment January 31st, 2018. So they're going to have an accounts receivable on their books from selling that equipment to that customer. It goes on to say, Eximco also purchases raw materials from a Mangaguan supplier at a price of 300,000 Hmongs. It will make payment on January 31st. So that's going to result in an accounts payable on their books. To hedge its net exposure in Hmongs, Eximco enters into a forward contract. Remember, the two ways you can hedge that translation gain or loss is either by signing a forward contract or purchasing an option. Now, when you sign a forward contract, you are locked in. you've got to convert at whatever you signed at. They entered into that 2-month forward contract on November 30th, 2017, so the date of the transactions, to deliver 200,000 mongs, so the net, to the foreign currency broker in exchange for $104,000. EXIMCO properly designates its forward contract as a fair value hedge. Remember, it could be a cash flow hedge or a fair value hedge, but this is a fair value hedge of a foreign currency receivable. The following rates for the Mong apply. So on the date of the sale and the purchase of EXIMCO made, the spot rate, so the rate that of conversion, was at 53 cents. And if you signed a forward contract, it was at 52 cents for January 31st. If on December 31st, the end of their year, the spot rate was at 50 cents, and if you signed a contract on December 31st, your forward rate would have been 48 cents. And finally, January 31st, the spot rate is 49 cents, so is the forward rate. Okay, because they're not going to sign a contract the day of the conversion. So November 30th, what do? Prepare all journal entries and adjusting journal entries to record these transactions and the forward contract. Well, as we said, the first thing they did was they sold, being promised to be paid 500,000 mongs on January 31st. So they're going to debit accounts receivable, not for 500,000 mongs, but the US dollar value of 500,000 mongs on November 30th, which was 53 cents per mong. So 53 cents times 500,000, debit accounts receivable 265,000, credit sales. On that same day, they purchased stuff, promising to pay 300,000 mongs. So they're going to debit inventory and credit accounts payable for the 300,000 mongs times 53 cents. So we could record it in US dollars. Now, on December 31st, the first thing they want to do is determine, is there any gain or loss related to the accounts receivable? Well, if they if they were paid back their 500,000 mongs on December 31st instead of January 31st, they would only receive 500,000 mongs times 50 cents per mong, or 250,000. As of November 30th, when they made the sale, they were supposed to get 265,000. So as of December 31st, this decrease in the value of the mong causes a foreign exchange loss that must be debited, and we must decrease accounts receivable to the US dollar amount we would have received on December 31st. Now, when it comes to the accounts payable, it's the opposite. So on December 31st, if we had to pay back the 300,000 mongs, we take 300,000 times 50 cents per mong, we would only have to pay 150,000. But as of November 30th, we would have paid 159,000. So we actually gained because the mong decreased in value. So when you owe money and the mong goes down in relation to US dollars, you have a gain. So we'll credit foreign exchange gain for 9,000, debit accounts payable, because you would be paying less. Now we have value related to this forward contract. The day we sign the contract, there's no value in it. You're just signing a piece of paper. But now that these exchange rates are changing, we do have value. And because of that, as of December 31st, we must record that value as a forward contract. Now, how do we do that? Well, we use the forward rates. And what we do is we go, okay, we are supposed to receive 500,000 mongs, but we're going to have to pay 300,000. So let's subtract them. So net, we're supposed to receive 200,000 mongs. If we received them at the forward rate on November 30th, we would have received $104,000. Okay, so that's basically what we would have signed on that day. Sign the contract that day, get $104,000. What would we have received if we signed it on December 31st? Well, those 200,000 mongs, we would have only received 48 cents per mong, or 96,000. So we take that difference, 104 minus 96, that $8,000 difference, and we determine the present value of it. And if you see the little one there, it says 0.9901 is the factor for the present value for 1 month where the annual interest rate is 12%. And they tell us it's 12% in the problem right underneath our little chart. And it gives us the present value factor of 0.9901. So the difference between the forward rates isn't recorded as a gain or loss. What is the present value of that? So that is the value of the forward contract, the 8,000 times 0.9901, or $7,921, and that is recorded as a gain. A gain. Okay. Now, and why is that a gain? Because we signed the contract on November 30th. We did sign it on November 30th. If we had waited till December 31st, we would have signed it for less. Okay, so we actually have that dollar difference in the forward rates is our gain, discounted to present value. So the impact, because that's the question, what's the impact on each year's income? 265,000 are the sales. The foreign exchange loss due to the mongs, the value decreasing, net is 6,000. There was a loss of 15, a gain of 9. And then the gain on the forward contract is 79.21. So the net result would have been a gain on that 265,000 to 266,921. Let's keep going. So what happens the day we pay back the accounts payable with mongs and we receive the mongs and accounts receivable? Well, the first thing we do, as always, is we have to write our accounts receivable up or down to the current spot rate from the end of last year to January 31st. Any loss from the end of last year to January 31st is recorded in this year. So the spot rate on December 31st, 2017 was 50 cents. It now has decreased to 49 cents. So it's lost another penny per mong. So 1 cent times 500,000, debit foreign exchange loss of 5,000, credit accounts receivable. Now, if we just take a time out and do a T account for our accounts receivable, let's go back up to November 30th. Remember, we debited that for 265, and then due to this loss that occurred last year, we had to credit it for 15, and now we're going to credit it again for 5,000. So as of right now, the balance in accounts receivable has decreased 20,000 overall to $245,000. accounts payable is going to go the opposite way, and we're going to have a gain, because if the US dollar has decreased when converting the mong by 1 cent, we're going to save 1 cent per mong when we pay back this accounts payable. So 300,000 times 1 cent, debit accounts payable for $3,000, credit the foreign exchange gain. And we could do the same thing with accounts payable. Grab a T account, make a T account. We credited accounts payable for $159,000 back on November 30th because that's the spot rate at the time. We debited it at December 31st because the rates changed and there was a gain. And then we debited it again for $3,000. So it's actually gone down $12,000. And as of January 31st, we're only required to pay $147,000 according to actual spot rates. Now, the next thing we do is determine the fair value of the contract, the forward contract. The forward contract has gone, so if we bought this contract, or I shouldn't say we signed this contract on January 31st, we would have had a conversion rate of 0.49, but we didn't. We signed it back on November 30th, and our conversion rate is 0.52, 3 cent difference. So 3 cents times 200,000 mongs, that gives this contract a $6,000 value. Or a change in fair value, it's decreased. It went from 79.21, remember it has that value at December 31st, and now it has a value of 6,000. So it decreased in value 19.21. We want to make a journal entry so that the forward contract's balance in that account is 6,000. So we'll debit the loss on forward contract because it went down in value and credit the forward contract. The next thing we want to do is like we did before, transfer our accounts receivable balance that's at $245,000 into our foreign currency account because we received the mongs. We just didn't convert them to cash yet. Same with the accounts payable. We're going to pay the mongs. So we debit accounts payable for the $147,000, credit the foreign currency. So overall, we have 200,000 mongs. What we are debiting and crediting for is the value that we currently have in those accounts. What the accounts would be, what value they have in US dollars as of January 31st. And if we never bought this or signed this forward contract, that we would have, that's what we get, 245, and we'd have to pay 147. We'd only receive a net of 98,000. But we said back on November 30th when we went into these transactions, today the spot rate is 53 cents. If we sign a contract, we're guaranteed 52. And we have to honor that 52 cents because we're signing a contract. And we're going to sign that if we think the value of the mong will decrease in terms of US dollars. And that's what happened here. It went from 53 cents down to 49 cents. And if we never signed this forward contract, we'd be stuck receiving 49 cents per mong. But because we signed this contract, we're going to receive 52 cents per mong. So our cash net is 200,000 mongs, 500,000 we received, 300,000 we had to pay. So we're going to convert 200,000 mongs, 0.52 cents for cash of 104,000. Our foreign currency account will have a balance of $98,000 on the debit, so we credit it. And then our forward contract sucks up the rest of that amount. That's where we store that difference, is in the forward contract account. And we do that by assessing its fair value. It all works out. So that was a great problem to see both the side where you're receiving an asset and you have to pay a liability using forward contracts. Now, the impact then in 2018, there's a net foreign exchange loss 2018 of $2,000. $5,000 from the receivable is a loss, but $3,000 from the payable is a gain. And then the loss on the forward contract. Okay, so what's the overall impact? Well, $265,000 was the sale. We added $1,921 in gain, subtracted $2,000 in loss, and subtracted $1,921 in loss. So overall, there was a $2,000 loss. And why is that? Because the forward rate on November 30th was a penny less than the, I'm sorry, I said that wrong. I'm looking at the book, spot rate. The spot rate on November 30th was 53 cents, and we locked in at 52 cents. So we automatically took a $2,000 loss on those mongs for that 0.01 cent difference. But it's better than taking a 4 cent or 5 cent per mong loss. And that's why that contract was signed. So I'm going to stop the presentation there. Hopefully that's enough to help you guys out and start wrapping your head around this whole idea of foreign currency translation and how we record it when we do have these kind of transactions. So take your time, look through it. If you have any questions on any items, just please post them out on the discussion board or email me.